Hello, we will talk about intermediate accounting, chapter 14, bonds payable. Okay, and now what if the issuance was at discount? Okay, now again, this is an example from the book, from Kiso book. Assuming now that Santos issues 100,000 in bonds. Again, the 100,000, it's the face value. Due in 5 years, so this is N, it's 5. With 9% interest payable annually at year end. So again, the 9% given, it's the stated rate. The issuer will decide the stated rate, which is the 9%. Now, at the time of issue, the market rate for such bonds is 11%. So as you can see, the stated rate, it's 9%, while the market rate, it's 11%. So the stated, it's lower than the market, so it's going to be issued at discount. It means the present value will be lower than the face value. Okay? Okay. So the stated, it's 9%. The market, it's 11%. The face value, it's 100,000. The present value, it's unknown. We need to calculate it. The payment, again, we have periodic interest payments. We need to pay them annually at the year end. Okay? So I'm gonna take the 100,000, which is the face value, and multiply it with the stated rate, which is 9%. It's gonna be 9,000, which means me as a bond issuer, I'm the one who sold. I need cash today. So I'm gonna issue bonds to receive cash today, but I will pay them later on. I'm gonna pay two things. I'm gonna pay the face value, which is the 100,000, once in the future at maturity date, which is after 5 years. Plus, I'm gonna pay 9,000, which is periodic interest payments. I'm gonna pay them annually, so I'm gonna pay them 5 times at the year end. 5 times. Okay? So I need to find the present value for these two. I'm gonna need to calculate the present value for the face value, the 100,000 that I'm gonna pay after 5 years only once, and I need to find the present value of the payment, which is the 9,000 that I'm gonna pay 5 times. Okay? Okay, so now to compute the present value, I need to go to the present value tables. Since he said that I'm gonna pay the face value, the 100,000, at maturity date, which is after 5 years, so I'm gonna pay it only once in the future. So I'm gonna go to the present value single sum table. When N, it's 5, because the period, it's 5 years. Okay? And I, it's the market rate, which is 11%. Okay? So we're gonna go to the table and look for the factor. It's gonna be 0.59345. So we're gonna multiply it with 100,000. We're gonna get 59,345. Okay, and now we need to compute the present value of the payment that we're gonna pay 5 times. The 9,000, I'm gonna pay it 5 times. So I'm gonna go to the present value annuity table. So when I pay the same amount more than once, we go to the annuity table. Okay, so we're gonna go to the annuity table. When N, it's 5, I, it's 11% market rate. Okay, so the factor is 3.69590. We're gonna multiply it with the 9,000. We're gonna get 33,263. We're gonna add it to the 59,345. We're gonna get 92,608. So again, when the stated rate is lower than the market rate, so as we said in this question, the stated was 9%, the market rate was 11%. So it's going to be issued at discount. So again, the present value will be lower than the face value. So as you can see, the present value now, it's 92,608, which is lower than the 100,000. So when the stated rate it's equal to the market rate, it's issued at par, so the present value will equal the face value. When the stated rate is lower than the market rate, so the present value will be lower than the face value, and we're gonna say it's issued at discount. When the stated rate is greater than the market rate, so the present value will be greater than the face value, and it's going to be issued at premium. Okay, now the journal entries. At the issuance date, today I need cash, so I issued bonds. So I'm going to receive cash today, I'm going to pay them later. So cash will go up in the debit side because it's an asset. Assets increase in the debit side. While my liabilities will increase because I'm going to pay them later. So my liabilities, which are the bonds payable, will increase in the credit side. And the amount will be the present value. As you can see, it's 92,608. Okay? Now, at the end of the year, I need to adjust my records. Okay? So, when it's issued at discount or issued at premium, I need to prepare something called amortization table. It's going to be easier for me to journalize. So I'm going to do the amortization table now and I'm going to explain it. Okay, so when we have issuance at premium or discount, we have to draw the amortization table. So as you can see, date, cash paid, interest expense, here discount amortized or premium amortized, and here is the carrying amount of bonds. Okay, so at the date of issuance, which is January 1, 2022, we don't have any payments, no interest expense, no amortized discount or premium. We will just write the present value here, okay, which is 92,608. Now after 1 year will be our payment. So on January 1, 2023, cash paid, it's the payment. We said face value multiplied by the stated. The face value, it's 100,000 multiplied by the stated rate, which is 9%. So it's going to be 9,000. It's going to be fixed. Okay, ما بيتغير. It's constant. 9,000, 9,000, 9,000 for 5 times. Okay. Interest expense, how do we calculate this one? We take the carrying amount, which is here, carrying amount, we take this one and we multiply it with the market rate, which is 11%. So this one will change. Okay, ليش؟ لأنه the carrying amount is changing. It's gonna change. But the face value, it's fixed. It's 100,000. It's not gonna change. Well, stated, it's fixed. It's 9%. Okay, so the payment will not change, but the interest expense will change. We're gonna take the 92,608 multiplied by 11%. Now discount amortized, it's the difference between the cash paid and interest expense. Okay, the difference between these two numbers, it's 1,187. Okay, now the difference, shall I add it to the carrying amount to get the new one? Will I subtract it? It depends. See, الفكرة من الامortization table انه I start with the present value, I end up with the face value. So if it's issued at discount, the present value will be lower than the face value. So to reach 200,000, I'll add the difference. I'll add the 1187 each time. We're gonna add the difference. But if it was issued at premium, the present value will be higher than the face value, so I need to subtract the difference each time. But now, when it's discount, I'll add each time. I'm gonna add, so 92 plus the 1187, we're gonna get 93,795. Okay. Now after 5 years, we're gonna do this line 5 times. After 5 years, you should reach to face value. Okay. So let's talk about the accrued interest here. So again, at the end of the year, at December 31st, I need to accrue my interest because it's incurred but not paid yet. So it's interest expense to interest payable. Interest expense, it's this one, interest expense 10,187. Interest payable, how much I'm gonna pay? The payment, it's 9,000, but did I pay? Not yet. I'm gonna pay it tomorrow on January 1. Okay, 9,000. What about the difference? Now to balance the entry, I need to record the 1187. Now how can I record it? So as we said I'm gonna add it when it's discount. I'll add it, so we're gonna add it to what? To the carrying amount of bonds payable. It means I will increase the bonds payable. Okay, bonds payable, it's a liability. If I want to increase it, so I will credit this account. If it's premium, I'll decrease it, so it's gonna go to the debit side. Okay, now on January 1, 2023, what's gonna happen? I'm gonna pay this interest, so I need to decrease the interest payable. It's gonna go to the debit, cash will go to the credit side. Okay, now this is another example from the KISO book. Evermaster AG issued 100,000 of 8% term bonds on January 1, 2022, due on January 1, 2027. So again, the face value is the 100,000, the 8% is the stated rate. As you can see, January 1, 22 until January 1, 27, so N it's 5, with interest payable each July 1st and January 1st. So as you can see, we're gonna pay twice in a year, so it's semi-annually. Okay, investors require an effective interest rate of 10%. So he's saying that the market rate is 10%. Okay, so again, the stated is 8, the market is higher, it's 10. So when the stated is lower than the market, it's issued at discount. Okay, but what's gonna happen here? Okay, let's see. Now, when he says that the payment will be semi-annually, what shall we do with I and with N? See, the N, we need to multiply it with 2, because it was 5 times, because 5 years. But now we're gonna pay twice a year. Okay, so مرتين بالسنة. So I'm gonna multiply it with 2. So N will not be 5, will be 10. While I, this is the annual rate. So you're gonna divide it by 2 to get the semi-annual rate. Okay? Okay. So the stated it's 8%. We're gonna divide it by 2, so it's gonna be 4% for 6 months. The market it's 10%, so we're gonna divide it by 2, so it's gonna be 5%. And it's 5 years, but we're gonna pay twice a year, so we're gonna multiply it with 2 to get 10 periods. The face value it's 100,000, the present value it's unknown. Now the payment, I need to multiply the face value by the stated rate. So 100,000 by 4%, it's gonna be 4,000. Now, to calculate the present value, I need to find the present value for 2 things. I need to find the present value for the face value and the present value for the payment. So the face value, I'm gonna pay the 100,000 only once in the future. Okay, اللي هي الفيس value 100,000. I'm gonna pay it only once. So I go to the single sum table, present value single sum table. When N it's 10, I it's 5. See here, present value table. When N it's 10, I it's 5, the market rate. When we go to the tables, we always use the market rate, not the stated. Okay, the stated will be used only to calculate the payment. Tamam. So we get this factor, we're gonna multiply it with 100,000, so it's this. Now I need to compute the present value for the payment, which is the 4,000. Okay, the 4,000, I'm gonna pay this amount how many times? I'm gonna pay it 10 times. Okay, because I'm gonna pay it for 5 years, twice a year. Okay, so it's gonna be 10 times. So we go to the present value annuity table, because I'm gonna pay this amount more than once. Okay, so I'm gonna go to the annuity. Okay, so we go to the ordinary annuity table. When N it's 10 and I, the market, it's 5%. Okay, so this is the factor. We multiply it with the 4,000, we got this. Now we add these two, the present value for the face value and the present value for the payment. It's 92,278. Okay, 92,278. So this is the present value. Okay, present value, as you can see, it will be lower than what the face value. ليش؟ لأنه ال stated it's lower than the market rate. Okay, so this is the difference. It has to be amortized. We call it discount on bonds payable. This is the difference between the two. Okay, so here are the tables. Present value of single sum C, it's only $1. Okay, we go when it's the market rate is 5% and N it's 10. So this is the factor. Okay, we multiply it with the face value. While for the payment, we're gonna use the annuity table because I'm gonna pay the 4,000 10 times. Okay, so you go to N10, I 5%, the market rate. Okay, this is the factor. Okay, this is the factor. We multiply it with the 4,000, we get this. We're gonna add 61 to the 30 to get the present value total. So this is the amortization table. We're gonna start on January 1, 2022. We just put the present value here and the carrying amount. Then after 6 months, on July 1st, it's gonna be our first payment. So the cash paid will be the payment, which is the face value multiplied by the stated rate. 100,000 multiplied by 4%, because the stated is 8% annually and our payments are semi-annually, so I need to divide it by 2, so it's going to be 4%. So the payment will be 4,000. So as you can see, it's not going to change. We're going to have 10 payments, because 5 years, twice a year, so it's going to be 10. Interest expense will be calculated by multiplying the carrying amount by the market rate or yield, which is 10% annually. I'll divide it by 2 because our payments are semi-annually, so it's going to be carrying amount multiplied by 5%. And as you can see, it's going to change because the carrying amount will change. Okay? Now here you calculate the difference, which is called discount amortized, which is the difference between cash paid and interest expense. So 4,000 and 4,614, the difference is 614. Okay, now the discount amortized shall be added or subtracted from the carrying amount. See, here in the carrying amount, we start with the present value. We need to end up with the face value. So as you can see, since it's issued at discount, so the present value will be lower than the face value. So I need to add the discount amortized in order to reach 200,000 after 10 payments. While if it's premium amortized, we need to subtract. Okay, now let's see the journalizing part. Now on January 1, 2022, it's going to be only the present value. So again, I will receive cash today, I'm going to pay it later on. So cash will go up. Cash, it's an asset, it's going to increase on the debit side, and I'm going to create a liability account, which is bonds payable, and the amount is the present value. Okay, now the first payment will be on July 1st. Cash paid, so cash will go down in the credit side by 4,000. Interest expenses will always be in the debit side because they decrease equity. Now the difference is 614. Again, we said it's gonna be added to the carrying amount of bonds payable. So I will increase the bonds payable by 614. Bonds payable, it's a liability. If I want to increase it, I need to credit this amount. Okay? Now, at the end of the year, I need to record the adjusting entries, which is the accrued interest, because I did not pay it yet. I'm gonna pay it on January 1. So at December 31, 2022, I did not pay the interest yet, so I cannot write cash paid. Okay, so I'm gonna record the interest expense at 4,645 here on the debit side, and I will increase the bonds payable by 645. Okay, the difference will be not cash because I did not pay it yet. I'm gonna pay it tomorrow, the next day, on January 1. So what do I say? It's gonna be interest payable. Interest payable, it's a liability. I need to increase my liabilities. Now the next day, on January 1, 2023, I'm gonna pay the 4,000. So interest payable will go to the debit side because I need to decrease this liability. I paid cash, so cash will go down and the credit side by 4,000. Now we're gonna repeat this 10 times, okay? Because we're gonna pay 10 times, okay? At the end, at the maturity date, I'm gonna pay the principal, which is the 100,000. So the last entry will be bonds payable to cash. We're gonna switch this entry, okay? We're gonna switch this entry. But the value will be 100,000, which is the face value. Hope it's clear now. Thank you for watching. If you have any question, please leave a comment. Please like, share or subscribe.